Welcome to Taking Stock for the week ending the 18th of November 2022. I'm Kien, Trinh, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome, Matt.
Thank you, Kien. Thanks for having me.
Before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so only charts and tables presented today shouldn't be relied upon as a guide for future performance. Well, Matt, this week, volatility remains a key theme, it's mainly driven by commodities and also fears across the crypto markets. China announced the easing of COVID restrictions, with the officials unveiling a rescue package for its property sector. And this includes extending the loans and delaying bond payments for its developers. Remember, its developers were quite in significant amounts of debt. Now, this, of course, has helped the rebound across bulk and base metals, and that's followed on from months of underperformance on the back of slowing economic growth. So the rally in commodities such as iron ore and copper will no doubt support earnings from our star stock miners, including BHP, Rio, even South 32 and Metals X. Both BHP and Rio Tinto are expected to provide gross dividend yields of around 10%, with dividends expected to be fully covered by free cash flow.
And Ken, we have previously warned investors about the risks with investing in cryptocurrencies, especially now that the era of speculation has come to an end, and we've spoken about that a number of times in the past. And as we mentioned last week, this debacle with FTX having filed for bankruptcy, that's led to a surge in investors abandoning online crypto trading platforms to try and protect their digital assets. Now, blockchain, which is the technology behind cryptocurrency, allows for transactions to be stored and updated on a decentralized public digital ledger. But as has always been the case when we're adopting new technologies, the process of actually finding an effective use case and then implementing the technology across the business can be quite problematic. And this week, unfortunately, Star Growth Stock and Star Income Stock, the ASX Limited, announced that it is dumping its blockchain project, which was supposed to replace its aging chess settlement and clearing systems. And the decision was based on a report by its consulting firm Accenture, which identified a range of problems with the technology. So I'll throw it back to you here, Kien. How will this impact the growth and the income metrics for ASX moving forward?
Yeah, that sounds quite concerning, but the 250 million write-down roughly is not really expected to impact the earnings growth and dividend expectations for the company, especially in the immediate term. In fact, the company is reducing its capital expenditure on the back of this, which should allow it to improve free cash flow. But we are seriously questioning the judgment of management, given that they have failed to manage the program effectively and by cancelling it quite late in the process. And without a plan B, the operating efficiencies planned in coming years will not materialise, of course, and this could have an impact on the long-term earnings growth drivers of the business.
And the ASX share price has struggled over the year on the back of softer trading activity and growing regulatory scrutiny due to project delays and the exit of former CEO Dominic Stevens. With the remuneration of these executives in the millions of dollars, the ASX board suffered a first strike at its AGM in September. And currently the ASX is on a gross dividend yield of about 5%, but the research team is now assessing these active risks around management.
Yeah, definitely something that we'll be looking at over the next couple of weeks also. But within the financial space, we are continuing to monitor developments with Star Income Stock and fund manager Perpetual, who are now likely to proceed with their Pendle takeover after the New South Wales court hampered Perpetual's efforts to walk away from the deal. Remember, Perpetual did receive a $33 per share offer from a private equity consortium, and this event really impedes further upside in the future takeover offers of Perpetual. And although the company has revised its terms for their Pendle offer to lower the cash component, the market has now removed that takeover premium attached to Perpetual share price. That's why the share price actually dropped quite a lot this week. And as a result, the gross dividend yield has rallied to around 9%, but we will closely be monitoring these active risks in coming days, especially given that the short interest on the stock is quite high at around 10% over the last few months. And now, turning our attention to poker machines and online gaming star growth stock, Aristocrat Leisure, they released a bumper result with earnings growth of 22%, but its net profit margins is still quite strong, sustaining net profit margins around 19.7%. However, the stock was sold down on the day, Matt.
Yeah, it was. It was a pretty ordinary day for Aristocrat shareholders. And although the result from our viewpoint was at least broadly in line with market expectations, we feel maybe investors were a bit disappointed by the flat revenue growth achieved from its mobile gaming division. We note that its online gaming division, Pixel United, now contributes just under 50% of total revenue. So we can't really look at Aristocrat as the old slot machine business any longer. And in addition, capital expenditure is forecast to increase over the coming years to gain traction in that online real money gambling sector.
Yeah, if you can recall, interestingly, last year the company completed a 1.3 billion equity raising for the acquisition of online gaming company Playtech, but that failed to materialize. And despite the dilutionary impact of this raise, the company was able to maintain its high rates of return on equity at around 22% because they conducted a share buyback and also generated earnings growth, which outpaced the 5% increase in the number of shares on issue. But more positively, though, Aristocrat now is sitting on a cash war chest of around 564 million, which is supporting its financial health, but it also allows it to undertake future acquisitions to drive earnings growth of around 15% this year.
And moving on to our corporate calendar, borderline star growth stock and cloud-based software provider Technology One is expected to report its annual results on the 22nd of November. We will also be closely monitoring the AGMs of other star stocks, including Pro Medicus, WiseTech, and Arena REIT next week.
And under the microscope this week, we look at non-star stock, Elders, an agricultural business which sells fertilizer and crop protection. It also sells livestock, wool, and farmland as well. And the company released its financial year 22 results earlier this week, revealing an attractive return on equity of around 18.6% and revenue growth of 35%. And that was due to strong prices with these commodities. However, despite the positive profits and neutral earnings quality, its financial health rating continues to be an early warning.
Yeah, that it does. And as you said, at face value, the company does appear to be generating strong profits and cash flows. But if you look under that financial health bonnet, we can see that majority of ratios are an early warning in a marginal state. And the reason for this is due to its higher than desired liabilities, including accounts payable and total debt. And that liability base isn't sufficiently supported by tangible assets, as 18% of total assets are considered intangible. And if you dig beneath that, about over half of those intangibles are actually goodwill. And on top of that, the balance sheet also has very little cash and retained profits relative to the significant level of receivables. That is money that is owed to them.
Yeah, very interesting, Matt. Of course, the financial health is a risk management tool for us and allows investors to avoid those companies that have high insolvency risks. But in this case, the share price was still sold down significantly over the week, Matt. Especially after the company announced that long-serving CEO, Mark Allison, he's planning to leave the company next year. Mr. Allison, if you can recall, has been quite instrumental in the turnaround of the business, which almost went bust during the GFC. And in addition to this, you've got the outlook of the company, which is further clouded. And that's due to recent wet weather conditions that we've experienced here in Melbourne and also across the east coast of Australia. But that could impact the demand for crop chemicals and fertilizer, Matt.
Yeah, it could. And following this further share price decline, the stock appears to be trading at a 20% discount to its consensus price targets. However, we would categorise this stock as a potential value trap due to the risks regarding its health. Its financial health management uncertainty and that clouded earnings growth outlook you talked about there, which is tied to those unpredictable weather conditions. For those looking for financially strong companies in this sector, you can refer to the peer comparison table below, or use the Stock Doctor filter and screen for agricultural stocks under the business description field. Within this stock filter tool, you can also select stocks with the GICS classification, consumer staples, dig beneath that, food, beverage, and tobacco, and include additional fields such as financial health, earnings revisions, and price to consensus target.
And now for question of the week, with volatility across commodity markets expected to continue, the key question today is, how should investors manage commodity price volatility? Well, that heightened volatility has been caused by a number of factors, as mentioned earlier on in this episode, including changing China policies and support for its property developers. In fact, China accounts for 50% of global base metals demand. And furthermore, commodity inventories, as reported by the London Metals Exchange, have been trending downwards and are now at 10-year lows, which means that the supply shocks can have quite an impact to metal prices as well.
With all this volatility, Kien, we've got to ask that key question: how can we as investors manage this risk within our own portfolios? And for us, the answer always lies with diversification. You not only need to ensure that your portfolio contains at least 15 stocks to help you mitigate these idiosyncratic risks, but within that resources set within your portfolios, we try to look for stocks that have diversification across the commodity basket in their own asset base. So, for example, you've got stocks like BHP, Rio Tinto, South32, and IGO that are mining more than one commodity.
Yeah, and you can really see that split under the principal activity section, earnings breakdown as well. So refer to that if you need to. But the other benefit of investing in these companies is that they are large, low-cost producers that have high-quality assets, infrastructure, and of course, very strong balance sheets to help you ride through those challenging economic conditions, knowing that they are unlikely to collapse during a global economic downturn.
Yeah, that is true, Kien. And lastly, I think everyone should consider commodity prices are extremely volatile, and hence we should not try to predict where commodity prices are likely to go, especially over those short-term timeframes. Even the expert analysts find it extremely difficult, and this can be seen with the large earnings revisions for resources sector that we've experienced in the last 3 months alone. It's important for us to focus on the facts and the numbers, and that is to look at its financial health and various other factors that are important for the business, such as invested capital, earnings quality, and free cash flow.
And let's not forget, Matt, volatility can create opportunity, especially if the share prices of quality resource stocks have been sold down significantly on the back of contagion or macroeconomic fears. Well, that's all we have time for today. Time certainly flies when you're having fun. But thanks, Matt. It's been quite a busy week for us, especially, trying to discuss those active risks and the management of those positions with Perpetual and the ASX.
Yeah, look, hopefully things start to quiet down as we sort of move into into the Christmas period. But again, Kien, thank you for having me on.
A pleasure, Matt. And just a reminder, we do have Lincoln Live sessions on Mondays. So that's where our team of experts, really, including Tim Lincoln, will be there to help answer your questions on stocks, strategies, and the market. But to summarize this episode, do not try to predict markets or commodity prices. As Warren Buffett once said, forecasts may tell you a great deal about the forecaster, but they tell you nothing about the future. Remember, focus on portfolio risk management through diversification and selecting companies based on their fundamentals, such as financial health, their past performance metrics, and also the outlook and active risks. For now, have a happy, healthy, and prosperous week, everyone.